Should I pay off my mortgage early or invest that money instead? If you've ever asked yourself this question, you're not alone. It's one of the most common dilemmas I hear from clients, and the answer isn't as simple as you might think. I'm Andre, and today we'll be breaking down the mortgage versus investing debate so you can make the smartest decision for your financial future. So, why this decision matters? Let me start with some context. Back in the 1990s, when mortgage rates were hovering between 7% and 10%, the answer was pretty straightforward. Paying down your mortgage often made sense. But today, many homeowners are sitting on mortgages locked in at 2.5% to 5%. This changes the conversation. If you can borrow money at 3%, but expect long-term investment returns to be between 7% to 11%, the opportunity cost of paying off the mortgage becomes significant. And by opportunity cost, I mean the potential gains that you're giving up by not investing that money instead. This decision could shape your retirement lifestyle, your tax picture, and even the legacy you leave behind. So let's dive into both sides of this debate. The case for paying off your mortgage early. Peace of mind and clarity. First, let's talk about why some people choose to pay off their mortgage early. Dave Ramsey often says that the grass in your backyard feels different when you own your home outright. And there's truth to that. I've worked with clients, especially those approaching retirement, who have ample savings but can't shake the discomfort of carrying debt. For them, paying off the mortgage isn't about the numbers, it's about knowing that they can achieve their desired retirement lifestyle without that monthly payment hanging over them. If you value certainty and peace of mind, eliminating a large debt can be a gift to yourself and to your heirs. A guaranteed return. Here's another way to think about it. When you pay off a 3% mortgage, you're effectively earning a guaranteed 3% return. This strategy especially appeals to those near retirement who want less volatility in their financial lives. Cash flow flexibility. Without a mortgage payment, your monthly expenses drop dramatically. That's powerful when you're moving into retirement or considering scaling back work. For many high earners, reducing fixed costs means more freedom, whether that's starting a business, pursuing passion projects, or simply having more breathing room in your budget. The case for investing instead. Now let's flip the script and look at why investing might be the smarter move. Higher expected returns. Historically, the US stock market has returned about 12% since the Great Depression, while bonds return 4 to 7%. Even after taxes and inflation, these numbers typically exceed recent mortgage rates. Here's a concrete example. Investing an extra $2,000 per month instead of prepaying a 3% mortgage could grow into $983,891.82 in 20 years. This is assuming annual compounding at a 7% return, for example. For today's households, that kind of compounding can have a significant impact on wealth and legacy. Liquidity and opportunity. Money invested in the market stays accessible. If life throws you a curveball, you can draw on investments more easily than tapping home equity. Sure, you can access home equity through a home equity loan, but that's not something you can set up quickly and in an emergency. The tax benefits of keeping a mortgage. Mortgage interest rates remain deductible for many high-income households, with limits. If your itemized deductions exceed the standard deduction, mortgage interest can lower your tax bill. Plus, keeping a mortgage may free up cash to fund other tax-efficient strategies. For example, backdoor Roth contributions, charitable giving, maximizing 401k deferrals. Key factors to consider. So how do you decide? Here are the key factors high earners should weigh. Time horizon. If you're 45 with decades ahead of you, the growth potential of investing usually outweighs the appeal of paying off a mortgage. But if you're 65 and approaching retirement, the stability of being debt-free might be more attractive. Risk tolerance versus risk capacity. Many clients overestimate their tolerance for market swings. High earners often have the capacity to take on risk, but not always the tolerance for sleepless nights when the market dips. Understanding both helps guide the decision. Tax planning opportunity. This isn't just a personal financial decision, it's a tax decision. For example, if you're considering Roth conversions, keeping liquidity may be more valuable. If charitable giving is a priority, investing can create more tax-efficient donations strategies. A blended approach. Here's the good news. You don't have to choose just one path. A blended approach often makes the most sense for high earners. That means making extra principal payments each year and investing aggressively in your portfolio. Targeting mortgage payoff by retirement while keeping assets compounding today. Using bonuses or windfalls to reduce debt without sacrificing investment growth. So let's look at an example. The executive near retirement. Nina is 55 years old. She's an executive with a 3% mortgage, planning to retire at 65. She decides to split her strategy, investing aggressively during her peak earning years, then shifting excess cash to accelerate mortgage payoff closer to retirement. This allows her to make meaningful progress on her mortgage while still building a comfortable retirement nest egg. And now, example number 2. Chris is a 45-year-old business owner with fluctuating income. Instead of tying cash into his home, he prefers liquidity. Investing provides flexibility to handle business cycles, tax planning, and growth opportunities. His strategy also gives him the opportunity to pour back into his business as he grows and maximizes his value for a future sale. These 2 examples show how unique this decision is for your time horizon, clear path, and overall financial goals. Making your decision. At the end of the day, this debate is not about the numbers alone. It's aligning with your values, goals, and your financial plan. High earners and high net worth individuals have opportunities beyond the average household. The right decision considers your overall investment strategy, your retirement timeline, your tax planning opportunities, and your comfort with debt. What's best for you? The truth is, the right move is personal. Consider investing when the tax advantages of mortgage interest don't outweigh conservative estimates for investment returns. On the other hand, consider paying off the mortgage when the tax advantages don't outweigh the benefits of having a paid off home. At A Small Investment LLC, I collaborate with clients to run the numbers, weigh the trade-offs, and align decisions with their bigger financial picture. Sometimes the math favors investing. Sometimes peace of mind favors paying off the mortgage. And often the smartest move is a mix of both. If you're ready for clarity on this decision, I invite you to book a meeting with me today. Let's make your next big money decision with confidence. You can find a link in the description below, along with additional resources to help you on your financial journey. I'm Andre, and I'll see you in the next video.